Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. There is no relief in sight. The market remains volatile. Both equity and fixed income assets are taking a beating as investors grapple with 40-year high inflation and the Federal Reserve's attempts to rein it in. My next guest says there is potential upside in this tumultuous market. He claims high volatility has historically had a positive effect on a little known class of bonds known as convertibles. He'll explain why adding convertible bonds to your portfolio is a smart move as we weather this financial storm. Michael Miller is President and Chief Investment Officer of Wellesley Asset Management, Inc., where he is responsible for convertible bond research and product development. He directs the firm's trading, private client, and institutional teams and oversees day to day operations, strategic planning, and execution. Michael, tell me more about your background and the history of Wellesley Asset Management.
Absolutely, Bob. Thank you for having me on this morning, and I'm excited to talk about this topic that certainly means a lot to me. So, our firm, Wellesley Asset Management, I think has a very interesting history. Our founder, who founded the firm in 1991, he came from a line of entrepreneurs who essentially lost their wealth in the stock market. Our founder's grandfather had a successful chain of drugstores. He sold them in the 1920s and lost all of his net worth during the Great Depression. The founder's father had an industrial cleaning supply company. He sold it for over $1 million in the early 70s and lost it all during the bear market and high inflation period of the 70s. And our founder sold a medical device company in the 1980s and really sat down and said, what the heck am I going to do to not lose this wealth in the stock market? How do I make it not three strikes and you're out for the family? And he began researching everything he could about absolute return investing, principal protected investing, and he fell in love with the convertible bond that really offered exactly what his risk profile would tolerate, which is that ability to kind of play both sides of the stock and bond market. Since that, Wellesley Asset Management has grown really from investing the money of our founder to being a multi-billion-dollar investment firm that manages convertibles for high net worth individuals, banks, institutional investors, wirehouses, and most other investing classes throughout the country. My background, I went to school for finance, went undergrad at American University. I got an MBA at Babson, and I was working for a large RIA in DC on the search and selection committee finding managers. I saw the performance of Wellesley Asset Management and saw their strategy, and really, I loved that ability of what they offered, which is, there's so many firms out there that are a jack of all trades, master of none. And when I saw this really niche firm focusing on a very niche asset class, I was taken aback both by the performance in the firm. I transitioned to Wellesley in 2008. I've been very fortunate to oversee some terrific growth, and that really brings us probably to the present of where we sit today, being a leader in the convertible bond asset class.
Well, let's talk about the president. And I'm going to assume that our audience of financial advisors knows the mechanics of convertible bonds. How have they fared so far this year? I think of a convertible as a bond plus an option to buy an equity. If we break it down into those two components, how has each of them performed?
Yeah, I'll back up a little bit because most people look at convertible bonds as that's the one asset class. Here's how they perform, and how are they doing this year? How should they be doing? And there's really two sides to that coin of how you play convertibles. There's the very aggressive equity-like way to play convertibles, where these convertibles, due to their embedded convertible features and being able to transition into equities, can capture the vast majority of equity upside and potentially equity downside. There's another way to play convertibles, which is what our firm specializes in, and there's an asset class and a benchmark, and other firms do this, that really use them more as a bond plus type of allocation. They buy these bonds close to par value. They have a significant amount of embedded protection, against equity downsides, and they work very, very well as that enhanced fixed income allocation. So when I talk about convertible investing and specifically what our firm does, and on today's call, some of the benefits, I'm more focusing on the using convertibles as a bond plus fixed income allocation, less so against what a number of other firms do, which is using convertibles as maybe a more muted equity approach. And when you look at convertibles, specifically convertibles that are being used as a fixed income alternative or a fixed income plus investment, they've been faring extraordinarily well this year for a number of factors. Convertibles have historically done well during rising inflationary periods. Convertibles bought in this strategy typically do well during rising interest rate periods. And right now, what we're seeing, I mean, if you just look at the ICE, Bank of America, Merrill Lynch, all yield US convertible index, it's down just about the same amount as the Barclay Ag, which is surprising. You would think with equities down 20+%, this fixed income asset class would be down more than traditional high quality corporate bonds, but it's not, because it's not feeling a lot of the punishment that traditional bonds are feeling from this environment of higher interest rates, this environment of inflation. So I think it's really a time where investors are struggling for how do I play fixed income, and this can be a great time to discuss a little known asset class as convertibles.
So we're in an environment where we're facing higher volatility than we have, say, last year. We're still faced with high inflation. Some may think it will come down. What makes convertibles an attractive choice now?
Yeah, and I think I touched on a little bit. You can so throw around buzzwords. Oh, they do great when there's inflation. They do, they can do well when there's rising interest rates. But what does that really come down to, and what does that mean? I mean, I mentioned that the index is still down this year, so we're certainly not generating positive returns in this environment. But the biggest thing that we look at, and what even that this index focuses on, is duration. Right now there's a convertible ETF out there with a duration of about 1.5 years. Our clients, our firm, our duration is around 2 years. The index is very similar. You compare that to a benchmark like the Barclays Ag or even municipals or high yield, where you're looking at 5, 6, 8, 10-year durations, and it all of a sudden allows you to play in a fixed income asset class without taking that long dated risk, without having to worry about when do I get this money back. I think if you look at an asset class like the Barclay Ag today, and you say I'm down 13, 14%, if I have to wait 6 or 8 years for those bonds to mature, if I have to wait, for that date certain time of a bond to mature, that can be a long wait. When you look at a convertible bond portfolio and why are they holding on better than they should when equities are down so much this year, it's because investors are starting to say, if I can move into a bond but have that date certainty be a year away or 2 years away, where I know that I can get that principal back, it becomes a significantly more attractive investment, specifically in the fixed income realm, than a lot of the other competing fixed income asset classes.
So you've minimized to some extent the duration risk, but there must be other risks. Where is the downside to the strategy?
Yeah, it's funny that the downside in a way is also the upside. I mean, so the downside is if we're in a roaring bull market, and I mentioned, we're the more conservative, act more like a bond type of convertible asset class. So when you're in a roaring bull market, we're going to underperform not just equities by a relatively reasonable margin, but we'll underperform a lot of the other convertible bond managers who are tracking equities more closely. So that's one downside. Now let's focus on the present. We're not in a bull market. We're in a bear market. So what are the downsides about being a strategy like this? Well, typically we would say you're going to have some equity volatility around your portfolio. So if stocks are down 20%, we'll probably be down more than traditional bonds because you have that draw of equity. There is some equity correlation anytime you're buying a convertible bond. So that's one of the downsides people see with using convertibles as a bond replacement, because they say, well, boy, why do I want bonds in the first place? I want bonds for that full level of protection. I want that to be my rainy day situation. And I think that's why we're having this conversation today, because it's so unique that in this environment, and I've been in convertibles now for 15 years, in an environment where stocks are down so substantially, the conservative convertible bonds are not underperforming traditional fixed income because of those benefits we talked about, because their duration's shorter, because they're more agnostic to interest rate changes and inflationary changes. And I think that's why The typical risk, which is, well, if we get in a really, really messy situation, like let's call it a 2008, you know, convertibles should be down more than traditional bonds due to that equity sensitivity. But because we're in a more unique environment now, unlike 2008, where we're in a messy situation, but on top of that, interest rates are spiking, inflation is spiking, and those are two things that don't hurt convertible bonds. We're now seeing convertible bonds act just like traditional bonds, giving that same level of protection, even with a volatile equity profile. So, like I said, that's a traditional risk, but it's a good time to talk about, the timing of convertibles in this market.
So you're seeing convertibles act like traditional bonds. Where are investors typically using them within their asset allocations?
We like to talk about as a fixed income plus or an enhanced fixed income or any other buzzword you want to add in, Bob. But it's really it's a niche in a portfolio that many people don't even have carved out. And as I said, I've spent 15 years with convertibles and I've seen them positioned everywhere from conservative equity, alternative to core fixed income. But I think where if you look at the standard deviation, it's a little less than high yield bonds. If you look at volatility, if you look at the protection, these are first and foremost bonds. It's a convertible bond portfolio is 100% fixed income, and that's where we like to allocate it in the fixed income allocation. Now, whether you want to call it enhanced fixed income and have it sit next to your high yield bonds, that's fine. But certainly, we believe, especially in a time like this market where I think investors are starving for fixed income ideas. This is the first time in a very long time investors have woken up and seen red on the top and bottom of their statements. And we get it. We know when we go out and buy equities that we can expect a level of losses. We know there can be volatility, but how do we fix the bottom of our statement? How do we fix that fixed income allocation to saying, if there's going to be rates rising for the foreseeable future, if there's going to be inflation for the foreseeable future, how do I invest in bonds and not worry about having these double-digit losses staying in my portfolio? And that's why we like to allocate these types of conservative convertibles right into a traditional or traditional plus fixed income allocation.
You spoke earlier about the two types of convertible investors. Your style is to look for bonds that are trading at or near par that still have this equity option attached to it. When you look at the securities that fit within your criteria, what are the key considerations you make when you evaluate a potential candidate?
Yeah, I mean, the goal of our firm, the goal of our strategy is reduce volatility by all means possible. So what does that mean? If we don't, if we want to protect and reduce volatility, we like duration to be as short as possible. I think I mentioned our duration's around 2 years. Obviously, quality is very, very important. We're buying bonds here, right? And what do bonds say? Bonds say we're going to pay you interest and we're going to give you all your money back on this date in the future, absent the company defaulting. So that absent the company defaulting is a very important part of the equation. We want to make sure we're buying what we deem to be some of the highest quality companies, strong balance sheets, strong income statements, and we want to, again, that's another tool to reduce volatility. One of the most important things we look at when buying convertibles, and I think it's a very important point when people start doing some analytics and looking at convertible bond investors, is we traditionally only enter and buy a new convertible bond when it's trading at or near par value. If you think of the example of a convertible bond, Microsoft brings a big convertible bond to the market. It's issued at $1,000. Well, if Microsoft stock does very well, before you know it, due to that embedded convertibility feature, that bond can be trading at $2,000. We would never go into the market and buy a $2,000 convertible bond because at the end of the day, Microsoft still says we're only promising you back that 1,000 on maturity. So you could feel a loss of 50% seeing that bond go from 2,000 to 1,000. By buying and maintaining a portfolio of bonds trading at or near their par value, it really insulates you from a significant amount of volatility in the market. I think that's when you look at our firm and our strategy and you look at really how we performed in this market in 2008 and really any bear market, even going back to the tech bubble burst of the 2000s, we're able to do a phenomenal job of creating a portfolio that has a lower average bond price than our peers, and thus that really reduces volatility, that reduces drawdowns in the portfolio. And for us, that's what our clients are looking for. I think that's what is one of the most important things that we offer, is sort of that sleep well at night strategy of, I know there's a mess out there in the world. I can put CNBC on, I can put Bloomberg on, I can read about all the geopolitical environments going on, but at the end of the day, I want my investment, or this sect of my investment portfolio, to be a sleep well at night strategy. And that's what we strive to achieve the way we buy, purchase, and trade our convertibles.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day. So why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. What is the yield on a typical bond that's trading at par compared to the yield on a similar non-convertible bond with a similar duration?
That's one of the prices you pay to have the equity upside. So if a typical company is going to come to market and say, I'm going to issue a convertible bond with a yield of 5%, they might say, and I'm also going to issue a convertible bond with a yield of 3%. So there is a discount there. That discount changes when we were at a 0% rate environment. It may have been, we're going to issue a bond at 2%, or we're going to issue a convertible bond at 50 basis points. Today, we're kind of approaching a more normal interest rate environment. So we're back to, maybe I'm going to issue a bond at 5% and a convertible at 3%. So that's the cost that having that equity upside is. We're going to get a little bit less income. But with our strategy, I think a lot of folks who invest in convertibles, we like to look at that income as your worst case scenario. I mean, typically, which sounds crazy. I think most people buy bonds and say, well, best case scenario, I get this income every year and I get my principal returned to me. With the convertible investor, we look at the interest as sort of the worst case scenario. That's assuming not a single stock in our portfolio goes up. All we get is the interest. Hopefully, and the way, the reason most people invest in convertibles is you want that equity kiss. You want to say, well, if I'm holding these bonds for a couple of years, ideally these stocks will go up and I'll get 40, 50, 60% upside against those equities.
So from a corporation's point of view, they're able to issue debt at a lower interest rate, but they're also sacrificing some dilution from their shares. What is the logic, the calculus that corporations are doing? Why would they choose to issue a convertible bond?
Yeah, there's two reasons. One is the obvious one, which you just mentioned, which is, hey, instead of issuing a bond at 5%, I can issue a bond at 3%. And there's some intrinsic savings there. And that makes sense as we move into a higher interest rate. I think we're going to see more and more of that. The question I would get a lot was, 1, 2, 3, 5 years ago. Well, why do companies want to issue these convertibles? Rates are so low. Why not just issue straight debt? They've got the risk of dilution. And the second reason is actually the more common reason. It takes a little bit more of an explanation, but you know typically if you're sitting at your desk as the CFO of a company and you're bullish about the future of your company and you think there's a lot of upside in the future of your company, but you want to go out and raise $100 million, you've got two traditional ways to do that. And let's say my stock is trading at $10 a share. I can go out and dilute all my stockholders at $10 a share and raise, by issuing more stock, I can raise an extra $100 million. That's A. Or B, I can go out and issue a bond for $100 million. But, at some point, let's call it in 5 years, I'm going to have to cough up $100 million and pay everyone their money back when that bond matures. The third option that the savvy, bullish CFOs can do is they can say, listen, I'm going to issue a convertible bond. Well, sure, it's a little bit less interest, but what's more exciting for me is if my stock goes up over the next 5 years, no one is going to come and knock on my door and say, hey, pay me my $100 million back. Because if the stock goes up by 30, 40, 50% over the next 5 years, and I'm bullish and I think it is, everyone's going to end up converting that bond and making a lot more money than just coming and knocking on my door and asking for their $1,000 back. Now what I've done is I've taken this huge $100 million liability that I thought I was going to have to pay back in 5 years, and I've wiped it right off the books because, again, no one's going to come and ask for that $100 million back. And yes, they diluted my stockholders, but they didn't dilute my stockholders at $10 a share. They diluted my stockholders at 13, 15, 18, whatever it is, whatever that stock ended up doing over those next 5 years. So I did dilute my stockholders, but I did it at a much higher price than had I just gone out and issued $100 million at $10 a share. And so that's sort of the secret that a lot of CFOs know about, who are bullish on their companies and say, I want to raise some capital, but I want to do it in this savvy fashion that sort of protects me from having to pay all that money back, but also protects me from diluting my stockholders at today's share price.
Where do they typically sit in the capital structure? I assume they're junior to equities. Are they're senior to equities, but are they junior to non-convertible debt?
It really depends. You're right. I mean, you're always going to be significantly senior to equities. We've seen senior secured convertible bonds. We've seen a lot of companies, their only debt is a convertible. So it's one of the most, senior claims. I would say for companies that issue straight debt and convertible debt, more often than not, they sit right after the straight debt. Sometimes it's reversed just because they did the convertible first and they go to the straight debt market. But on average, if they have both straight debt and convertible debt, you'll see the straight debt being slightly above. I mean, sometimes it gets a little bit into semantics as far as the pecking order in the event of a default, how senior secured you are in the bond ladder. But at the end of the day, what's important to note is these are bonds. They are typically rather senior in the hierarchy there, certainly when you're discussing equities and other claims on the firm. So that's, again, sorry for that long answer, but I guess the short answer is it depends, and that's typically what we see.
Who is your typical investor? And you mentioned that usually they're looking for lower volatility. What else distinguishes the type of investor that typically uses your products?
Yeah, what I was discussing earlier is there's a lot of challenges to investing in fixed income. I think most of our investors have sort of been through the market long enough to know I don't want all my money in a very volatile asset class. So whether that's equities, whether that's Bitcoin, whatever that may be, they understand the value of safety, principal protection, and a low volatility part of their portfolio, but they've struggled with fixed income. I think a lot of folks look at the traditional fixed income market this year and say, oh, it's really bad because it's down 13 or 14%, maybe 15% today. But it's been relatively bad for a very long time. You have a lot of investors who probably have tried and failed at timing the market, right? So they say after 10 years of a bull market, they say, this has been such a drag on my portfolio holding these bonds. The equities are going up so much. Bonds are only doing 2, 3, 4%. I want to time the market and move these risk off assets into equities. And they do that at the worst possible time. Or they're sitting in a bond portfolio and it's down and they want to move to cash because the bonds are down, and they're probably doing that at the worst time. Investors who come to us, they say, I don't want to have to worry about timing the markets anymore. I don't want to have to worry about figuring out, if you put on CNBC or Bloomberg, is today the bottom? Is last month the bottom? Should I buy the dip? Is the Fed going to raise into next year? Or do bonds have more time to fall? The beauty of a convertible bond, it's a hybrid investment. It can act like, look like, feel like a stock when stocks are going up, and it can act like, look like, feel like a bond in environments like today or bear market environments when stocks are going down. And investors come to us because they say, I want that safety, the safety that we've talked about on today's podcast, but I also don't want to have to worry about timing the market. I don't want to have to worry about, am I missing out? If 2023 ends up being a phenomenal rebound year and stocks are up double digits, am I going to miss out because I went into all these risk off investments during the bear market? Do I have to worry about when to buy the dip, when to sell? And that's the type of investor we have. I mean, typically it's whether it's institutions, whether it's high net worth, whether it's other registered investment advisors making allocation of us. This is the sleep well at night. This is the asset class that's really going to time the market for us. Like I said, it's not, you don't have to worry about, is this a good year, a bad year, what's the Fed going to do? It's going to kind of be that hybrid investment to act like what you want it to be in the market, whether it's capturing equity returns or whether it's providing fixed income protection. And that's where investors come to us. They come to us for a solution in their portfolio of saying, what can I put in there that should be able to weather multiple different types of storms, whether it's interest rates, inflation, bear markets, etc. And that's really the solution we provide to investors and why they come to this asset class.
If our listeners want to access your investment strategies, what products do you offer?
So we offer a plethora of products all around this one core convertible bond strategy. So we have a family of mutual funds, we have separately managed accounts, and we also have a private hedge fund. So obviously, if they want to look us up, they want to contact us, we'd be happy to go into more detail about while all those products circle around our one core convertible bond discipline, how they differ, how they vary, and really what's appropriate for each investor.
If there's one key takeaway that you would like to leave with our audience of advisors about how convertible bonds will behave now in this environment and the approach that Wellesley takes to managing them, what would that be?
I think what we offer, and if I'm speaking directly to the advisors, we manage a lot of money through the advisor channel. And what we offer is a tool in that advisor's toolbox to say to their client, there is a solution. I think so many clients, as I mentioned earlier, they're looking at the red on the top of their statement. They're looking at the red on the bottom of the statement. They're watching the news, which is not very optimistic. And they're saying, what do I do? Where do I go? And what's happening is they're going to cash. And the second you move your investable portfolio into cash, you're becoming a market timer. You now not only have to think that you got out at the correct time, you have to know when to get back in. And what our strategy does, especially in a very challenging asset class known as fixed income, it offers that solution. It offers a solution to allow investors not to have to worry about being a market timer. It allows a solution for investors to be able to be in fixed income, but not have to continue to worry about Fed decisions and the negative impacts they're going to have. And I think that's really what we offer. We offer something that a lot of investors don't even know existed out there. And just to kind of backtrack a little bit, convertibles, it's a 150-year-old asset class. I think railroads in the mid 1800s were some of the largest issuers of these convertibles. They've always been purchased and gobbled up by institutional investors, pensions, endowments, folks of that insurance company, folks of that nature. A lot of retail investors don't know that this is a solution available to them. And a lot of advisors don't know that this is a solution that they can bring to their retail clientele. And I think that's really where we like to preach the gospel and get that message out, that this solution doesn't have to be exclusively for endowments, pensions, insurance companies, and banks. It can certainly be brought to a retail investor's portfolio within their asset allocation.
Well, we will include a link to the Wellesley Asset Management website where you can learn more about the products that Michael mentioned, and you can get in touch with him and his team to ask your questions. Michael, is there anything else you'd like to add?
I'd just like to thank you for the time this morning, and it was a pleasure being on your show.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire today featuring Michael Miller of Wellesley Asset Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable here for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.